So hi everyone, and good day or good night depending on where you are on that globe. We're making the replay today for those who can't watch us live and join us in here in the Discord. Tonight or today's topic will be the step one of the strategy. This is what users voted for. They decided to talk about that, and I'm quite happy they took that choice because from what I can see, this is one of the things that most of the users are having troubles to handle. So it will be good to dig a little deeper into this today. And that topic is quite interesting, so let's not lose our time in here and get it started. What you have in your screen right now is what we just done in French, so don't worry, we're going to rewrite this in English, of course. And alright, let's just start it. So the step one of strategy is really one that most of you guys are either not really doing well or not doing at all, and that's two big issues you really have to come across. You don't really want to miss that step because it's maybe not really the most important, because this is the entire thing that is important, but missing one step could lead you to general mistake that you will be doing, and that could lead you to introduce risks inside the strategy. And basically introducing risks means more losses in the end on the overall strategy's return, which is what you want to avoid. So once again, that strategy is based on limiting the risks to the minimum, and so inducing risks on the inside is not really something you want to do. So checking the context is basically going to orientate the technical framework, the step two. So stepping in right into step two is not really what you want to do, because checking the context is going to give you conclusion in order to search for the technical framework and a specific technical framework. Because basically, whenever you take care of step two, you'll have generally multiple choices. Even if you use, let's say, for example, Elliott waves or just trend channels, you will generally have the opportunity to build upward trend channels or downward trend channels. And the element that is going to tell you which one of those two you should prefer and pick up is that context analysis. So this is why that step is really important. For another thing, for something else, it is important because it's going to help you adjusting the leverage accordingly to the underlying risks you have on the higher time frame. Because checking the context must be done on the higher time frame than the one you're trading, and a simple rule must be respected absolutely. If you ever trade on a 1 hour time frame, you need to have at least 6 to 8 ratio between the local context you're going to trade on and search the technical framework on and the step one. So for example, trading H1 time frame means that you cannot have a look at the context in anything that is below H6 or H8 time frame. If you're having a look at 4 hours chart, you're totally out of context. You're not really looking at the context. It's not higher the time frame enough to consider that bigger time frame. And the goal is simply to have a clue of what's happening in the major framework, and making sure you're not trading against a possible trend, and according the potential leverage you're going to use according to that context. So really is an important step that you don't want to miss. Anyway, that being said, let's get into more interesting information. So the question you will ask yourself is really simple, is what is the context? Okay, this is what we wrote in France. So what is the context? It really is a simple question, but I wrote it down anyway. So this is a question you asked. The answers you can get out of this are those. The answers are whether you are trendy, which gives you two options, because you got uptrend and downtrend. Okay, Then you got range, which is, once again, the most difficult thing to get. And you got neutral range, absolutely neutral. You don't even know the asset is basically oscillating bullish, bearish inside a big range. And this is neutral. It basically has no odds to get upward or downward. It's just basically going to oscillate in between. We're going to eventually see some example, but for example, AUD, NZD, on a monthly basis is absolutely a range, a rangy range. It's a neutral range. You don't have any idea if this thing is ever going to extract from the upside or the downside. You don't really know about that. So this is neutral. Then you got neutral bullish, which is basically a neutralization of a bullish trend that still has potential. Means that you're simply ranging the price to get some air. You're basically breathing in to breathe out, and you're just temporizing and waiting in some price area, working out some volume before probably going to restore the trend and move to the next resistance we could find in the meantime to reach out to the final target points. Okay, so this is neutrality, but inside a highly probable going to continue uptrend. Okay, and in those ranges, so it is neutral bullish, and we're going to call that neutral bearish. Okay, means that this is not really obviously going to keep on pushing the uptrend or the downtrend, but the probabilities are slightly bullish or slightly bearish. And you're going to adjust accordingly, and we're going to talk about that. And you got neutral, absolutely neutral, which will, of course, have some conclusions as well. Then you got the bubble market. Okay, so this is what you guys just discovered recently, because most of you guys are just trading the Bitcoin and cryptocurrencies. So you basically get into trading the markets, but you only knew and you only lived through two different kind of market, which is the most the rarest. Don't know if this one exists. Market you could get, because if you had to, for example, give some clues about the percentage in terms of time we spend in the overall markets, bubble and crash are nearly 5 to 10% of the time we spend in global markets. So it really is negligible in terms of time. So what you think is the market, because this is what you guys just learned, and that's basically the only thing you've been trading recently. Bubbles and crashes, this is just 5% of trading. So don't make the mistake of thinking that what you've lived through recently is the market. It really isn't. And if this is 5 to 10% regarding the overall time we spend into markets, then trend is nearly less than 20%. And 80% of the time is ranging. And this is the hardest thing to trade. So listen to me carefully when I tell you that patience is the essential quality to be a trader, a durable trader. It's because 80% of the time you're going to be into this situation, and it's the trickiest to trade. So what you've just learned is really, to me, the easiest thing to trade. The bubbles and the crashes. So if you're having trouble trading those two today, be aware that what is next to come for you is even harder. Because trading a trend, as you can see, it's pretty easy, and most of you guys have been trading this. Because before we installed the bubble in the Bitcoin market or in the cryptocurrency market, we were trading an uptrend. Okay, so you might have already faced an uptrend scenario. So you basically know how to trade trends, and basically that's the easiest. But it's even easier to trade bubbles and crashes. It's a little bit harder because you need to know how to trade those patterns. And I'm going to teach you how to do this, because the strategy is really simple when you're in the bubble and when you're in a crash. And we're going to talk about that later on. So just make sure that you don't make that mistake of thinking that what you've been seeing the latest 6 months or the latest year on the Bitcoin or cryptocurrencies is a normal market behavior. It is absolutely not. It's just bubbles and crashes, and this is not what the market is generally doing 80% of the time. So, that being said, moving on. Bubble crashes. Now that you got the possible answers, these are the only answers you could get out of the what is context question. If you are in a trend, which kind of trend is this, up or down trend? Normally you shouldn't ask that question. The answer is really obvious. Then in a range, you forecast yourself, is this a range ongoing in a major uptrend or in a major downtrend? In this case, you're going to call that range neutral bullish or neutral bearish. And if there is absolutely no range, if this is a range inside a range, you're going to call that a neutral range. Then you got the bubble when the asset is going crazy bullish with no volume or low volume and going totally parabolic. You can't really miss a bubble when the thing are going crazy and everyone is buying, not really knowing why. It's just buying because others are buying. And when you see this, generally it doesn't end well, and it generally ends with a crash, which is simply the opposite. When you got a bubble, you got a crash. It has to end that way. There is no bubble who can end any different than a crash. The crash is the opposite of the bubble, and you cannot have one without the other to come later on. So we're going to talk about those once again later in a greater details. We're going to start with what the markets are doing 80% of the time, which is either trending or ranging inside the trends, or even ranging inside ranges. Okay. So basically, where you're on a trend, consider this. We're going to take the uptrend as an example. Yeah, screen sharing is down. Thank you for telling me. I'm going to reconnect this. We had an interesting question from High-Vol who said, does the context time frame also decides how long you stay in a position? Yes, it will. We're going to talk about the conclusions later on, and we actually were going to talk about that because the timing can be decided, you can never ever anticipate timing. It will never happen, but you can somehow give some limits to the timing you want to see, because the trends are generally lasting quick. The trend is not something that lasts for a long period of time. You've got the trend burst, and then you get to ranges quickly. As I said, 20% of the time we're going to trends, and 80% of the time we're going to ranges, which means that whenever you are in a range, you'll have to be a lot more patient than when you are trading a trend. Generally, the topic, the definition of a trend is a move that switches the price from point A to point B in a directional move, which means that you should not see too many oscillations in between. The price is not nearly oscillating in a trend. It's basically going from point A to point B. Of course, there is sub waves. We're not nearly doing this in a straight line, but you should not see too many oscillations, which means that trends will generally get your targets faster than when you trade in ranges, and you'll have to get more room to the price to work this out whenever you are in a range. Okay, so this is how I will answer the questions of High-Vol. Now moving on. Out of the answers you can get, you're going to have to take conclusions, and these are the conclusions you could take out. So whenever you are in an uptrend, okay, so you selected the trend and you are in an uptrend move, what you would like to do is basically buying the bullish signals, okay, in a technical framework. So once again, if you check the technical framework, you are in a technical framework interesting price, and you have a bullish signal, you just buy. It's simple as that. Uptrend, bullish uptrend context, bullish framework, and bullish signal, you just get in, no problem. Then what you will like to do as well is, whenever you are in a trend, you can buy the double bullish signals, but you can also buy the breakout of bearish signal. Okay, because generally when you will break or get through the opponent's signals, means that if you're searching for call entries, for long entries, if ever there is a strong resistance, let's say a double bearish signal, and you see the price breaking hard through that level, meaning that you need to see a big candle, not just a candle closing above the level, you need to see a big reactivation candle with a nice open at the low, closing at the high, and volume. Whenever you see this, just get in and put a stop loss below the previous support. It means that the market has more aggressively entered, and you can join in. Whenever you are in a trendy mode, breaking the opposite signals is really something you want to get in if you are not already in, okay? Or you can eventually consider this as a reinforcement. The screen sharing is working for me. I see that working, so it should be good for you. Okay, sorry about that. Then the final conclusion you can take out of this is that all the taking profit and exit signals coming from the opposite side, okay? So TP and exit bearish cycles will simply be there to adjust the risk. So you're going to take partial profits or exit the trades whenever you have those. They need to be confirmed. Remember that. You just don't exit when you see the exit pattern. You need to have this confirmed by a triangle and confirmed by a momentum pattern. When you have those, you execute the action nearly instantly. It means that if this is a taking profit cycle, you just take 50% profit at least. And if this is an exit, you just get out. You'll eventually enter on later, but in the meantime, it's safer to get out when you have an exit, okay? So just secure the trade, okay? Once again, this is an interactive session. If something is said that you don't really understand or you need me to dig a little deeper into, just step in, ask any question, and of course I'll be there to answer right in context, actually. Exactly the opposite when it takes care of a downtrend. You're basically selling the double bearish signals. You're going to sell the double bullish signals breakout, invalidation or breakout. Because if you have a bullish breakout, you buy. If you have a bearish breakout, you buy inside a trend. You don't ask any questions. Okay? If sine wave's detecting any kind of breakout, you follow through. If this is in the side of your trend, of course, it really is that simple. So that is the opposite. Okay, it's really pure and simple, the opposite of what we have in here. This is where the tricky part starts, because whenever you are in ranges, and remember what I said, just 80% of the time, or let's say 70% of the time, you're going to be into those three options. And they are the trickiest one to trade, and the most trickiest one is that one, and once again, that's the one you'll see the most. 50% times it will be this, 25%, 25%. So this is what happens most of the time, and the best reaction to have out of a neutral is not to trade. Because once again, there are so many options, so many markets you can trade. Oh gosh, that's growth. You have so many options to trade, so many assets to trade, so many time frames. So why the hell would you use your time trading something that is not really relevant? Really don't lose your time trading an asset that is ranging inside range, because that way is going to be tricky, not going to give you the best risk-reward ratio, not give you the best odds to get filled in your taking profits instead of your stop loss, so not the best case scenario. So please avoid trading something that has no interest, and if you absolutely want to trade it, then lower the leverage accordingly. It really is that simple. Then what you're going to use inside ranges is basically the range strategy. And there is only one low-risk range strategy that you can apply if you absolutely want to trade in ranges. And once again, the best is not to trade. The best option in ranges is not to trade. But if you absolutely want to trade, I hope you guys have the answer, because this is the answer you like the most hearing me say it, is basically using the range strategy with the DOM zone. So whenever you have a range, okay, what you want to make sure of is not being into the DOM zone. And if you are, then what do we do inside the DOM zone? you just don't trade, okay? So if the answer you give to what is the context question is range, first thing first, you draw the range possible boundaries and you put Fibonacci retracement. And if you are inside the dome zone, you just get away from this. If your context is in the DOM zone, you don't even dare searching for a technical framework and even less a trading signal. You just get out of this. You just go away and find another asset or another time frame to trade. The context must not be inside the DOM zone. Never, ever. Okay, it's basically losing your time trading a market that is trading inside the DOM zone. So you'll have to ask yourself an intermediate question whenever you have the answer is range. Are we in the DOM zone? If you can check that question to be a yes, then you can move on to the next step. That is going to be the conclusion. And if your answer is no, just get away. Really is important to understand that. So in ranges, you're not going to do the exact same thing as right here. What you're going to do is, of course, buying the double signals. Okay, so anytime you have a double signal, you're going to buy it. Okay, you will be able to, you will have, to secure on opposite signals. Okay, which means that when you trade in a range, if you have an opposite signal, if you're buying and you have a double selling signal, you cannot ignore it just like you will in a trend. The opposite signals in an uptrend, you don't care of those. You just forget about those. All you care about is breaking them. The market can retrace down to a bearish signal in a bullish trend, but it will generally just retrace to create a new bullish cycle. So you forget about the bearish cycles unless they are taking profit and exit. And whenever you have those, you just trade accordingly. You adjust the risks. But whenever you have a bearish signal inside a bullish trend, you don't really care about that. All you care is the market breaking it upward. And if it happens, you put the reinforcement. If it's not happening, you're waiting to have a new double bullish signal in the trend to pay. Okay? And in bullish trends, you can actually, if you like risk, you can eventually consider buying just one of the two indicators. If the uptrend is really a nice trend, you can consider buying just out of momentum or just out of sine wave. If it's not necessarily confirmed by the other indicator, if the trend is really aggressive, you can consider using just one of the two indicators signals entry. But once again, if this is the case, you just divide the leverage. You reduce the leverage because you could go slightly lower to get the momentum confirmation or the sine wave confirmation if you're trading just out of momentum. Okay, in those cases, you basically trade with the leverage divided by 2, and you keep half of your leverage to eventually put a reinforcement if a double signals comes out lower later on. Okay, sorry. Right, so you basically buy the double bullish signals whenever you are in a range, and of course you make sure to be out of the DOM zone and eventually being as close as possible as the selling area or the buying area to get the best risk-reward ratios. What you do inside a range is to lower the leverage. You cannot put as much leverage as you will do in a trend, simply because in a range you'll have to give more room for the price to work that out, which means the stop loss cannot be set into very tight levels when you do trade inside ranges. You have to put large stop losses, and in order to do this, you need to lower the leverage. Because you need to know that putting a too tight stop loss in a range is going to lead you to the possibility to see that stop loss taken down, and which is what you absolutely want to avoid. Okay, so lower leverage inside ranges, lower leverage to have a wider stop loss. Okay, what you will do in here is, of course, secure on the opposite signal, what we've said, and you wait for the range breakout to reinforce. Okay, Because the goal, whenever you are trading a neutral bullish range, is to get that range breakout at some point, okay? Because the goal will really be this. What you want to do in a neutral bullish range is to take advantage and take some easy gains inside the range by trading smart and not trading dumb. Whenever you trade smart, you can make easy cash in ranges with low risk, but you make low cash because you have to lower the leverage. So this is not where you will make the big gains inside the range, but you can make tiny gains and easy gains anyway. And it's going down. Okay, so the goal, once again, is to get back into the trend whenever you terminated the range. And how do you see that happening? Is basically when you worked out the range and you can clearly identify trend lines, because ranges will have sub-waves counts that will allow you to build trend lines. And whenever you see the break up of the trend line, means that the range is probably over and that you can consider putting some reinforcement to the entries you might have made inside the range. You can trade counter trend at some point, which is that if you are trading in a bullish range, doesn't necessarily forgive you to take bearish entries. You can consider taking bearish entries even though it's a neutral bullish range, but once again, this is more risk, which means lower leverage. So whenever you trade counter trend, it's possible. Once again, it should be avoided if you are a beginner, because the less experienced you are, the less risk you want to take, which means that trading a counter trend signal is not something you want to bother yourself about if you are a beginner. Okay, but if you want, it's possible. You should avoid, but it's possible. So this is how you do trade this. Obviously, it is, again, the opposite when you get to a neutral bearish. And whenever you trade, if you even want to trade a neutral, then you do accordingly, and you can buy or sell depending on the conditions you have up there, but you do it with leverage. Same, but with very low leverage. Okay, as this is the highest level or the highest amount of risk you could take. Okay, so the more, once again, the more risk, the lower the leverage. So this is where you take the lowest possible leverage when you are trading neutral ranges. Okay, where you don't actually know how or where this is going to go when it exits. When it terminates, you really don't have no clues if this is most likely going to get to the neutral bullish, to a bullish trend or a bearish trend. And then finally the bubble. So how do you behave in a bubble? This is a tricky question. Okay, the answer is actually quite simple. How do you trade bubbles with the indicators? What you will do is basically buying any bullish signal. Just one of the two indicators more than enough in a bubble. Okay, so when you go to parabolic bullish moves or bearish moves, because you can actually no, the bubble is only bullish. Okay, the bubble, you don't have bearish bubbles actually. I've never seen one. I wouldn't really be surprised to see actually one, but normally it isn't possible in terms of liquidity distribution and complex thing I'm not going to get into today. So the thing is that when you are in a bubble, you don't sell. Selling is just impossible. You don't even try to sell inside the bubble until you get a few signals of the possibility to get the movement ending, and I'm going to talk to you about that later on. So you basically buy whatever comes out. Okay, so just a momentum bullish signal, okay, get in and put a stop loss below the previous signal. Okay. The structure in here is very simple. The stop loss has to be put below the previous low. If you have a support below, you put the stop loss below and you put the maximum leverage you can get, not risking, once again, more than 3 to 5% losses, and you just put the leverage accordingly. Okay, so the closest the support will be, the more leverage you can put, the further that support will be, the lower leverage you'll have to put in there. But any bullish signal is to be taken in. Of course, you place your trade on support areas. Remember that you have to take care of step 2. It's not because you're having a bubble that you can trade nowhere. Okay, you really need to build your trend channels and your trend lines and making sure you're not trading dumb prices. But if you are near a technical interesting price and you're having any bullish signal from sine wave or momentum, just get in. If you are in a bubble, just get in. Don't ask too much question and put a stop loss below the previous low, and you simply wait to have the price moving crazy up again. Don't get too much exposed in a bubble. Don't go into pyramid schemes. You just don't put too much leverage, because that's the biggest mistake you could do in a bubble. But you can buy not too much leverage and you pile up gains, and whenever you get to your maximum leverage, you just stop putting reinforcements. Okay, don't go too much into bubbles. That's a big mistake doing this. So buy whatever comes up. When you are respecting step 1, step 2, and step 3, you just get in, no questions asked. What you will do is putting the stop loss, moving the stop below the previous low. Okay, because generally in a bubble market, you never ever break down a support. Whenever you break down a support, means that the bubble is over and you missed the shot to the summit. If you missed the peak, once again, don't run after the prices, because bubbles, when they explode, do it violently, which means that if you have to trigger your stop losses, just give them to the market. Don't hold to your long positions when the market is failing a bubble. You just get it out, hopefully with a gain. Even if it's a tiny loss, just give it away. You'll buy later on and eventually forecast the crash. Okay, whenever the bubble is terminated, don't run after the price. If you missed the first bearish impulse, just don't run after this one. Wait to have the dead cat bounce pattern and move on to a potential crash trading. Okay, don't run after a bubble. That's once again one of the mistakes that most of the inexperienced trader will do. Inexperienced. Sorry about that. So the latest thing in here is to wait to have the movement giving signs of exhaustion. And this is where you'll be able to eventually forecast the bubble to near its end, because the bubble always ends in the same way. Okay, I'm going to give you technicals to find out how, and once again, it's impossible to predict. You will just have odds, and whenever you see odds suggesting this might be the reaching out topping point of the bubble, just take your profits if you can, and you can eventually enter once again later on, but take the profits if you have a doubt, because remember that the crashing pattern is triggering fast out of the bubble, and once again you'll be disappointed if you didn't take your profits earlier, because it's going to drop fast and give away some of the potential gains you had before. So waiting to have exhaustion signs to take profits. Actually, it's not taking profit, to exit and get out. And eventually reverse. For those who are really aggressive, you can eventually try to trade the first bearish impulse of a crash. But don't do it if you're lacking of experience. If you're a new trader, don't try to get that wave. It's really the hardest thing to get. I can get it, and you see I've missed the one on the Bitcoin. I took the one that we could eventually have on the SPX. If somehow the crash is triggering, I would have had that first bearish impulse, but really it took me quite a few losses in between to get that market top. So it really is a tricky thing to get. So don't really run after those prices. You better have to let them go and wait for the dead cat bounce. Okay, so this is where you do it. You wait for the exhaustion sign. What are those exhaustion signs? What you want to do, what you want to see in a bubbly market, you want to see volatility coming back at some point, okay? And you want to see the momentum making a new low, a lower low than the one it made previously. You see the market's going up, 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 and at some point there, it breaks the previous low. Whenever you have this, you know that you have the first sign of a nearing possible ending bubble, okay? And you have to do this at that point. Whenever the volatility pulls back in, you need to already be able to see the verticality of the price, the parabolic move. It's just the first sign that tells you that we are probably nearing the crashing exhaustion point in which the market will reverse brutally from bullish to bearish. Okay? Generally, the market, the impulse that relates after that volatility come back is generally lowering the momentum, plotting divergences on the momentum, and whenever you have this, you generally see a volume pickup in here. As you can see right here, we've got volume pickup and price reaching out through supports. You know at that point that this is terminated. This is the time to get out. You see, volume is dropping down, price is stopping to move, and whenever you have the volume pickup and price moving down, just get out. This is the end. You'll generally have sine wave triggering and momentum as well, but even if you don't have the signals from the indicator, because sometimes sine wave cannot manage to find the cycle correctly and it will miss the shot. So don't wait to have indicator signals whenever you trade a bubble. They can be out of synchronization and don't be able to find the right cycles. From time to time they will be, as sine wave got it perfectly on the Bitcoin, for example, but it's not nearly doing this as that good on other assets. Okay, but normally sine wave should synchronize again to get you the dead cat bounce signal in any time. Even if it don't get the top one, it will obviously normally get you the dead cat bounce pattern. Okay, it's just a time for sine wave to find some oscillations back in the market. As generally when there is a bubble market, there's no oscillations, which means that sine wave is totally lost. It sees noise and heavy trend and is lost in that kind of market. Okay, so don't wait for sine wave whenever you have a clear and clean exponential moving market. Just wait to see the volume dropping, the price stopping to move, and then whenever you have the volume pop up and price breaking through a resistance support, it's over. You reverse to the potential crashing pattern. At least you take your profits, and if you're aggressive, you can try to take advantage of that first bearish impulse, but once again, not for the inexperienced trader. Okay, and then you've got how to trade the crashes. Okay, so it's basically the opposite. You sell whenever whatever comes up. Don't be too aggressive on the shorts, because basically the cycles are lasting a longer period of time, which means that normally sine wave and momentum should find cycles, which means that it's not really sell whatever comes up in here. It most likely is the copy of a trend trading in here at the only condition that in here you'll be selling the double bullish signal. So double bearish, double bearish signals, you'll be once again selling as well. Selling bearish breakouts or invalidation of bullish signals. Okay, I mean breaking through bullish cycle is a bearish sign, and you're gonna take those as reinforcement or price entry if you're out. Okay, you're going to take as well, taking profit and exit bullish cycles as securing the trades, okay, but you never trade against a crash, okay? You cannot, in the ranges, once again, you can do counter-trend trading. You avoid doing this in the bubble and crashy markets, okay? One very clear example, where did I take a few stop loss recently? Because I was trading counter trend in here. I made a mistake. I shouldn't have done that, trading counter trend in the bubble. I should simply have waited. I wanted to take easy gains, so I decided to go counter trend, got trapped in, and gave me a loss. Tiny loss, because I knew that was risky, so I really lowered the leverage accordingly. But once again, I shouldn't have done that, and I wouldn't have taken that stupid loss. It really was a really tiny loss, so I didn't really care. But once again, that wasn't a smart choice. Otherwise, breaking that taking profit pattern should have been an opportunity to get down, and breaking the lows. Okay, so this is where I made a tiny mistake on the Bitcoin recently, not respecting the strategy. Because myself, I'm not a perfect person. I know my strategy, but from time to time, I get away from it, and that brings me a loss. That can bring me a loss. Okay. Once again, nobody's perfect, and I myself, as any other trader, even professional traders, I do take losses because I make mistakes. And even though I have 8 years of practicing and trading, I still do make mistakes. and generally the same as you. It's just that I'm doing them way less often than you, because experience has taught me how to get away from those situations, but yet I still do run into some of those from time to time. Okay, so you take this to secure the trade, and you're going to add one thing. You just keep that on going until volatility drops down, or price is breaking a double bearish signal. Okay, so if you have, so what have I told you basically on the Bitcoin? The latest double bearish signal we have is up there. It's not just breaking a double bearish signal. It needs to break a double bearish signal that relates to something. Okay, so it needs to be a price, a double bearish signal that the price have been trading. Okay, so this is the price you bulls need to break up in order to make sure you terminated the crash. As for now, to me, that crash pattern is still ongoing, because I have no signs that suggest that my context has been changing. I've been giving you early signs of what I could possibly consider breaking up resistances would be, for example, to work out the support area in here, retracing up to the bearish trend line, breaking it up, and then breaking that resistance of 9,800. If you do this, I think the market could be bullish and be ready to give away my stop loss, and mostly to buy to get that resistance and eventually forecast breaking that one up. Okay? And at that point, there will be no crash pattern activated to me, and I will switch to what? Because after crashes, what do? You don't go from crashes to uptrend. You go from crashes to neutral bullish and then uptrend. So this is the mistakes that lots of you guys have been doing recently, and that's a context mistake, thinking that we are going from crash to uptrend, which we don't. We go from crash to neutral bullish, then uptrend. Just as another mistake that most of you guys are doing, you don't go from uptrend to downtrend. You go from uptrend to neutral bullish, and that neutral bullish is not reactivating the trend, which means that you're switching neutral, then you go to neutral bearish, and finally you get to the downtrend. Okay? So be aware of this. You can eventually skip just one single step. It's going from uptrend to neutral bullish, from neutral bullish to neutral, and from neutral to downtrend when you got an aggressive breakout. But anyway, still has to go to neutral in between. You don't go from bullish to bearish. It never happens. There's only one case it can happen. It's the V-top structure and V-bottom structure. But when you have those, means generally that the context has been wrongly chosen. Okay? So make sure that you don't go too aggressively from up to down trends. And once again, the only market context that can switch from bullish to bearish is bubble to crash. It's the only market that will do a V-top and switch from bullish to bearish. But the crashing pattern is not switching from crashing pattern to bubble. It's going from crashing pattern to neutral bullish. Because actually the end of the crashing pattern is neutral. When there is no market move, you go to neutral, that gently and smoothly get to neutral bullish, and then you get eventually to an uptrend. All right? I kind of finished the presentation today. So if you guys have any questions, this is the time you want to step in. You can do it with your microphone if you have one, and you can do it as well by typing in the general channel if you don't. So Imajiko is asking question, I bet this is about the Bitcoin. What if the neutral trend was March to mid-April? Well, it is possible, because guess what? I don't know. Once again, I'm not making that market. I could be wrong about the Bitcoin, but in order to be wrong, I need to see a resistance broken up, and for now, I don't see any. means that the trend is still, the context to me is still an ongoing crash. And once again, from time to time, I be able to forecast the pre-signals of the end, which means that I'll see the volatility dropping down, and I'll have high probability to see and to be able to anticipate the end of the crash, just as I will be able to anticipate the end of the bubble and trading the first crashing pattern, but not all the time. From time to time, I'm simply not able to see the end of that pattern, and I might have missed the end of the crashing pattern on the Bitcoin. But once again, in order to see that, I need to see my context invalidated. And there's only two solutions. Either I see no volatility for an extended period of time, or I want to see price breaking a double bearish signal. For now, I have neither of those two, which means I keep and I stick to my context as long as it is not invalidated. I'm simply respecting the strategy. I don't really care, once again, being right or being wrong. Trading the Bitcoin is not just where I get my returns on investments. It's just one investing asset that I have among many others. And once again, being right or wrong in the Bitcoin is not going to change a lot to me. I'll still make gains elsewhere. Yeah, we're gonna do this, hey, but I'm not here to actually make a market forecast in here, because this is more likely going to be an educational content. So we're gonna do it if there is no other questions, but I'd like to have you guys questioning about the educational content, not just asking me to make forecasts. Okay? What you're here to get from me is not just forecast and potential trading signals. So once again, the more important thing in here is just to get to the how and what have I used to get to the conclusion, to be able to feed yourselves later on, not just being fed by myself. Okay, today's high touched the channel resistance, so I hope it will go down tomorrow. We'll see about that. I don't see no trend channel for now. All I can see is basically a wave 1 right here, which means that we terminated it as we exited the bearish trend channel. You can clearly see there was a trend channel in here, which is a wave 1, okay? So exited this means that we're working out a wave 2 in here. So it's basically wave 1, waiting to have wave 2 terminated. Let's see here or here. I don't really know. For now, all I know is that I don't know. Waiting for having wave 2 terminated. So I need to have a clean Elliott structure terminated. And then we'll have a wave 3. Or at best, if that market is bullish, A, B, C. And then we eventually reactivated the bullish trend if we build a support right here. But what I think we were most likely going to do is this. 4 and big nasty 5 wave. Okay? So once again, be patient and wait to see elements that give you reliable odds to trade. From what I can see right now, I don't know if we're in a bearish market. All I know is that we're in retracement at best, which means that if you want to buy, it's not the price you want to buy. You want to buy lower prices. That's what I said to the French guys. If you want to buy, just wait to have a second bearish impulse. And this is the one you will get to buy. Because for a bullish view of that market, which is not mine once again, for the reason we've been talking about today, and I hope you got that, why am I forecasting 1, 2, 3, 4, 5 Elliott count? Because I'm having a bearish context, which means I search only for bearish technical frameworks. I don't care if the overall outcome is bullish. I need to do my job to find a technical framework that confirms the context. So I have to forecast 5 bearish impulse, even if I'm wrong. It is not just about that. If I'm wrong, it means that I was wrong with my context. I'll eventually take a stop loss. If I take too much risk, if I done my job correctly as I just did right here, I'll take no losses. Because basically, if that market is invalidating me today, I'll take basically no losses. Because I've done a good job I've paid for my stop loss. I reinforced with good prices, which means normally I shouldn't take a stop loss even if I'm invalidated. Okay? I hope you guys learned a lot today. If you have no other questions, we're going to stop there. The first rule about the context to make sure we talk about the same asset. Yes, we're sure. We're going to do about Facebook just to be nice with you, high volt. But once again, making analysis is not really just a goal in here. Facebook is making a really nasty gap. So in Facebook, I might be nearing the invalidation of my scenario because once again, we're working inside wave 1 territory, which means that if this thing is bearish, it has to reactivate bearish tomorrow. If this thing is bullish, it's basically going to break that up. And that means that this was a BC structure and basically that I was right, that I was wrong, and that this bullish gap is going to reactivate a bullish wave that is going to make new historical highs. Once again, and in that case, I'll be wrong. I just got stopped out on Facebook. My stop loss was right there. I raised it a little bit just to make sure not being chased by the market above that top. And I got taken down anyway. So I'm out on Facebook. Stop loss is triggered, took a tiny loss. The stop loss was paid. It was paid to until up there. I raised it a little bit, which means I'm in negative return out of this trade. I took a tiny loss, but once again, that doesn't matter. What matters is that when you're wrong, the losses are not costing you a lot, and when you're right, you take a lot of gains. This is how you are and how you become profitable. It's not being magically right all the time, or not being too much wrong. You'll be wrong, and more than you think. The goal is just to lose a lot, to win a lot when you lose less. Okay. I'm sorry, John. I'm going to stop on making analysis. I'm not going to talk about gold, even though it's really interesting, I think. But I would like to first make sure no one else is having educational content questions. If no one is asking questions right now, I'll take that as I'm just a perfect teacher. I just got to the perfect courses today. You guys got everything I've been talking to you about. If this is such thing, then once again, I'm glad it is, but I'll just make sure it's the case. So don't be shy. Don't hesitate to step in and just write a comment. If anything in here needs to be digged a little bit deeper, this is the time to tell me about it. Now, in the meantime, I'm going to switch to gold and make that final analysis. So if you guys having a final question, just type in it. And otherwise, we just finish on analyzing the gold and going out. So the gold basically right now to me is still a bullish asset. But once again, what is this? What is this? If I trade 2 hour, we're going to get to daily. Okay, so respecting once again, need to make sure that I've been respecting at least 8 times the time frame I'll be trading on. So I do right here, got more than 8 times 2 hours in a daily candle. So what is the context I have right now? I want answers, and if you give me the wrong answers, and I want you guys to participate. You just don't listen in here. I want you guys to type, take your keyboards, and tell me what context is this. We move on to practical examples. This is where you need to participate. I just don't want to have only high volt participating in here. Please take your damn keyboards and tell me what context this is. Okay. I'd like more answers, please. Okay. A few more, maybe. Okay, you need to be more expressive, Maxim, because I don't really know what that means. Oh, BN for bearish neutral, maybe? Don't know. Just be more specific. Oh, okay, yeah, for neutral bullish. Okay, we're gonna wait for Rimco to give its answer. Come on, Rimco, don't be shy. No one is giving wrong answers. Once again, it's just like when we make multiple choice questions. Giving the wrong answer is the only possibility to get better. Okay, those who give the wrong answers get more confidence. Those who give the wrong answers will learn something to get better. So it's just a win-win situation in here. Okay, so we've got Simish who is going to post, maybe. Okay, I'm going to give you a few seconds to post that answer. And then I'll give you my answer. And once again, it's not, my answer is supposed to be better than yours, or at least a more reliable one. But once again, I could be wrong, and it happens. Okay. Normally, you don't really need to have more information than one you have in here. Of course, it could be great to have an outlook, a deeper outlook, but eventually just this is enough. Okay, from what you can see, this is clearly a range. Okay, so those who've been answering any different from the range was wrong. It basically is a range structure and couldn't be any difference. Now we have layers inside the range structures. So we got bullish range, neutral range, or bearish range. Okay, so from what I can see, I would answer bullish range, but I would accept neutral range as well. Okay, for a single reason, because normally we should have ended that range right there. The market should be reversing to bullish at the moment, and we can clearly see that it is struggling doing it. So I would say it's still a little bit too early to call that a neutral bearish range, but it's still hard to call that a bullish range as well. So it really is still possible to be a bullish range. Neutral range, I think, is an acceptable answer. Bearish range might be a little bit too soon because we need to break a low, a low point first. Because the latest thing we've been doing is breaking the previous high. So as long as that low remains a lower low than what we're doing right now, means that the odds are still to the upside. But once again, if we break it down, then at that point we could forecast neutral bearish. Okay? Are we clear on this? The answer is here. The answer here are two possible answers, either neutral, or neutral, eventually bullish. And it could turn to neutral bearish, but it's still a little bit too soon to forecast this. Okay? So whenever we do this, remember what we've done. I've gave you the answer somehow. You just put the Fibonacci levels and you don't trade anything that's in the DOM zone. Okay? You just trade at the boundaries, and as you can see right now, we're in the blue boundaries, which means that we search for bullish entries when we have bullish signals on the lower time frames. Really is that simple. Okay? So for now, we're on a weak bullish cycle. Momentum hasn't given us a single confirmation, but we can clearly see the momentum is divergent right now. Okay? So we have a divergent momentum with a weak bullish cycle that got broken down, which means that right now we can buy. Okay? Weak bullish means that the price will high probably going lower prices, and you can buy those lower prices. So we've got a whole bunch of supports right there that could be transferable to buy the gold. So buying gold right now is possible, but it's highly speculative and still needs to have the momentum reversing. So I would basically say wait a bit for the gold to hold that support area. See the momentum going upward and probably going to trigger a divergent pattern in here. As you can see, sine wave is there. Means that sine wave terminated a bearish oscillation. We're on support. Really, I think the odds are to the upside to me on that asset, even though it's neutral, which means that whenever we get to a resistance, if we have any sign of bearish reactivation, will take the profits, at least 50% profit. Oh, sorry, the screen sharing went down once again.